So most owners think money in the bank is their profit. It's not. Practically, when you start analyzing these can become very, very complex. Do you know why many businesses fail? They don't normally fail because they don't have profits. A lot of businesses, they have profits, but they fail because they don't have cash flow. Do you realize that? Do you know the difference between profits and cash flow? This particular episode, we are trying to do more specifically for small businesses, not for large at all. So don't compare in that way. In small businesses, most owners confuse between the profits and the cash flow. So most owners think money in the bank or money in their till is their profit. It's not. So primarily, you need to understand the profit is the difference between your income and your expense. But what is cash flow? So you bought the goods for $40, you sold it for $100. If your customer did not pay you the $100, what is your cash flow? Your cash flow is going to be negative $40 because you have to now pay your supplier. At the same time, you did not get the money from your customer. So it's a minus $40. So how long you can operate with that minus number? That's how the cash flow becomes very important. Now, this is only one simple example, buying at $40, selling at $100. But think about the regular business. Now you have employees, you have to pay rent, you have to pay all kind of utilities, and then you have to pay taxes, the big boy, and also there are so many other things come into play. Everything you have to pay on a timely manner. At the same time, if you don't get the money coming into you, it is going to impact in your cash flow. So that's the biggest difference between cash flow versus the profits. Having said that, which one you want to control? You want to control both. You have to know whether you are making profits. At the same time, you have to know whether the cash flow is enough. Now, generally when you go to banks, when you go to anybody, they will try to ask you, how is your working capital? So there is a subtle difference between working capital versus cash flow. Working capital is all your current assets, that is including cash in the bank, your account receivable, meaning your customers are going to pay you that money, right? And any other short-term money that is going to come in is taken as current assets. And then you take the current assets and look at the current liabilities. That means anything you need to pay in short term. What you are supposed to pay short term? All your expenses will fall into place. Payroll, government dues, your rents, your purchases, accounts payable. So all those. So the difference between current assets and current liabilities become the working capital. So that is also, you can in a way think that is your cash flow as well, because from the account receivable, you are going to collect your money. From the accounts payable, you are going to pay money. So the difference is working capital. So that's why when you go to banks, when you talk to other people, many people ask you, how is your working capital? How much working capital is needed? Now, when we talk very generally, it is very, very simple. It looks very simple. But practically, when you start analyzing these can become very, very complex. Now, in small business, the most people, what they forget is in the cash flow, some of the main elements is not only selling a product and you are buying the product or rent. On top of that, your loans, your line of credits, all those will add to your cash flow. So for example, if you have a line of credit, if you are going to take money from the line of credit and put it into your till, that's also cash flow. So even if your customer don't pay you, you can take the money from your line of credit and pay your supplier. So that means you have a cash to pay them. That will be part of cash flow. I can go even further. Say for example, you have a old, say forklift. Now, if you decide to sell the forklift, how that is going to impact your cash flow and the profit. So for example, imagine the same forklift you bought for $100. Over last 5-6 years, you write that off. Every year you write off some amounts. Now $60 is written off as a depreciation. So the net value of that particular asset, which is the forklift, is $40. Now you go check your second-hand dealer. The second-hand dealer says, okay, I can get you $50 instead of $40, even though your written book value is $40. So you get $50. So on the profit and loss statement, how it will reflect? It will reflect as your net book value is $40 and you got $50, so the profit is $10. But if you look at the cash flow, how it looks, it will show you as if you got $50 cash coming in. That is basically you are converting an asset into a cash. Okay. So in cash flow, there is a positive $50. The same way, borrowing also create from the line of credit. If you have taken $30 to pay your supplier, that is also positive in cash flow, but it is under borrowing. In the same way, sometimes people talk about, oh, I have an investor going to give me money. So investor come in, he give you say $200 for whatever you agree with him. So for example, you are going to give him 1% of your shares and he is going to give you 200,000. So that 200,000, is it going to impact your profit or loss? Not at all, because that's an investment. It goes in a completely different area of financial records or financial reporting. It is going to be only in the balance sheet. In the balance sheet, it is going to go into the shareholders' equity, or it's going to be a special area for that. But in the cash flow, what's going to happen? In the cash flow, it's going to show as money injected by owners or shareholding. So it's a positive cash flow. Especially the high-tech companies, if you look at it, what happens? They may be having losses year after year after year. So first maybe 3, 4, 5 years here they have losses. That means they have no profits, all losses. But they are managing. How they manage with all the losses? And sometime multi-million. If you look at some of the very popular companies like Uber and others, for many years they were showing negative profit and loss, meaning they are losing money. However, they were surviving because they have cash flow. How is that cash flow coming in? Because they are selling the shares and people think it's an exciting business and they invest in the company. They put money for their shares and those cash flow allow them to pay for all their expenses. That's how companies survive. So to make the long story short, cash flow is crucial for survival of any business.